Hi guys, so let's learn about IS 20 government grants today. Now, as the name suggests, government grant is something as an assistance coming from the government, right? Assistance coming from the government, specifically going to cater the monetary assistance that is going to come from the government, okay? Monetary assistance. The assistance could come for various types of tasks, a revenue grant and a capital grant, okay? We'll understand what are these two types and how to account for it in detail. Now, to start with revenue grant. What is revenue grant? Now, revenue grant is nothing but if government is going to give you money, is going to give you monetary assistance, monetary aid for your expense of the organization, towards the expense of your organization. Okay. So, expense would be the keyword here. This is how it would get differentiated from the other type of grant. Okay. For example, your organization is a hospital. Government is saying, please recruit nurses from so-and-so rural area for the next 5 years and we will be able to provide you a grant money of so much amount. Okay. So now for you or for the hospital, recruiting nurses is incurring expenses, right? And if government is able to give you grant money towards it, okay, to maintain them, then yes, it's going to act as a revenue grant. Now, how do you record? If you receive this money, how do you record it in your books? So, there are two types of treatment that are allowed. So, as per method 1, you're going to treat the grant money as a grant income in profit and loss statement. Okay. The word income will play a key role here. Okay. The income word is going to play a key role here. And the idea is you might receive the entire money in lump sum. So whatever amount you deserve for that 1 year, okay, is only what you'll be able to record as income in profit and loss statement, accruals basis, okay. And remaining that you don't deserve will be recorded as deferred income. So till the time the condition for deserving the grant is not met, the amount will stay in deferred income, okay. On day 1, mostly you have not met anything at all as a condition. So entire money would sit as a liability in deferred income. Okay. I'll get into the detail of what are the kind of journal entries that we'll pass. Don't worry. In some time, we'll crack numericals from that aspect as well. That is day 1, how do you record the grant money? Year end, how do you record it? We'll get into all those aspects. Okay. Now, method 2. What is method 2 telling us? Method 2 says instead of treating it as a grant income in profit and loss statement, treat it as a reduction towards the expense for which it is given. Okay. So here, treat grant as a deduction to the expense for which it was given. As a deduction. Deduction will act as a keyword because the deduction word and income word, this is how they are different in method 1 and method 2. Okay. Deduction to the expense for which it was given. The remaining rule is still the same. Till the time the condition for deserving the grant is not met, you will keep it in deferred income, the liability account, because it's nothing just like income received in advance. I would say a fancy word for income received in advance. You can consider this as income received in advance. Okay. Now let's check a numerical and let's see how this would get catered. So the example goes by $30,000 received as grant for keeping workers employed for 3 years at the beginning of the year. Okay. So 30,000 received as grant for keeping workers employed for 3 years at the beginning of the year. Now, assuming, taking the previous example that this is the nursing staff that we're talking about. Now, for a hospital, so how do we go about this? Now, as per method 1, where we credit as income to profit and loss statement, how would it look in my profit and loss statement? So suppose I have to draw a profit and loss statement. Now, I have my revenue, I have my cost of sales, I'll have probably in one of the line items or a line item called grant income. And up to the extent what I deserve, I'll record in my P&L. Okay. So if this is for year 1 and if year 1 has passed and if I was receiving 30,000 for 3 years, then of course it's only 10,000 that I deserve in the first year, right? So how did I get this? That's simply 30,000 by 3. 1 year has passed. So I'll just record a 10,000 of grant income. Okay, this is what I deserve in the first year. Remaining amount, where is it going to sit? It's going to sit in my balance sheet as a liability. It's going to sit as a liability in the name of deferred income. So this is going to be your 20,000. Alright. Now understand one more thing, that on day one, it's not even going to sit as a grant income in P&L, because on day one, you're not deserving anything. You've not even kept them employed for a day. Okay. When can you record in the P&L entire 10,000? When the entire 1 year has passed. So if you want, we can see how a day one journal entry would look like. So I would have received debit bank 30,000 and credit deferred income another 30,000. Now year end 1, okay, how would it look like in year end 1? So I deserve 10,000. So what I can do is I'll reverse the liability that I had created of 30,000 up to the extent of 10,000. So debit deferred income about 10,000 and credit, because now I deserve 10,000. So grant income I'll credit. That's the income that I'll show. Okay, so this is what I've shown in your profit and loss statement. After full 1 year is passed, 10,000 is PL grant income, and in my balance sheet I might have on day 1 a 30,000, but now it's reduced and it's at 20,000 because 10,000 I'm reducing it. Okay, so this is how your PL and your balance sheet would look like after year 1. Okay, after year 1 has ended. Now, if you would want to look at your PL and balance sheet at year 2, how it would look like is, you were again, because you have fulfilled for 1 more year, again 10,000 is what you will be able to record, and your liability will drop by 10,000, which means it will become another 10,000. In year 3, another 10,000 you deserve. So your deferred income will now become nil. Okay, deferred income meaning in balance sheet your liability will now become nil. Okay, so this is how it would progress. In terms of journal entry, this is the same journal entry you would prepare for year 2 and year 3. Okay, for year 2 and year 3, this is the same journal entry that you would have, and as a result, you can already see the flow in PLN in your balance sheet. Now, how would things progress in method 2, where you're not doing credit to your as an income to profit and loss statement, but you're doing a deduction to expense in P&L. Okay, you're doing a deduction to expense in P&L. So here, how you would do things is, instead of creating a grant income line item, you probably have something called admin expense line item, right? Admin expense line item. So what you would do in your year end 1 is, because you deserve a 10,000, you would reduce 10,000. Okay, so in year end 1, your admin expenses will drop by your 10,000. Okay, your admin expense is going to drop by your 10,000. I think the proper place would be to write it over here. Your admin expense is going to drop by 10,000. This is expense that is dropping by 10,000. Okay, and in the balance sheet, the same thing. You will have a deferred income at the end of year 1. You will have a deferred income at the end of year 1 up to the extent of 20,000. Okay. Now, how would your day 1 journal entry look like? So you have debit bank, because money is coming in up to the extent of $30,000, and credit deferred income again to the extent of 30,000. Now, how would your journal entry progress for year end 1? Okay, so debit, you're going to reverse your deferred income because you have already 1 year has passed. So reverse the liability up to 10,000 because you deserve that now. And credit, your admin expense. Admin expense would be a debit item in nature. Expenses are debit. But the idea is that you are removing from admin expense. That's why not debit, but the opposite of it, that is credit. Okay. So 10,000. And this is the same journal entry that will happen at year end 2 and year end 3 also. As a result, year end 2 P&L will have the same entry, a deduction towards admin expenses of 10,000, and deferred income, the liability will drop by 10,000, is why it will sit at 10,000 at the end of year 2. At the end of year 3, again because you deserve 10,000, so a reduction in expense of 10,000, and in balance sheet, again because a liability of 10,000 was standing and now you deserve the entire 10,000, so it will drop and it will come to 0. Now the idea why there is a difference in these two methods, okay, what is the concept? Why is there a difference in these two methods? The reason why the two methods are different or why these two methods are allowed, because people who use method 1, they say that they do not want to spoil the expense line items. Say for example, if the output is say about 1 million units, they would want the expense line item, selling and distribution line item and other type of expenses to be comparable, so that when we produce 1 million units, these are the expenses, okay. But organizations which use method 2, they argue that if we were not encouraged by this kind of government grant, we would not even enter into this kind of deal or into this kind of project of hiring so many people at this point of time. So they're saying only because we are encouraged, why should we write that higher expense amount? We will write the expense amount that we were from day one only ready to incur. Okay, so they'll write that, they will record the reduced expense. In this case, the reduced admin expense they will record. Okay, so that's the logic behind the two methods used by both the entities. Now let's continue to see how we would record or what are capital grants and how we would record for them. So capital grants are going to be those grants where assistance is coming from the government, again monetary assistance coming from the government, but now this time towards your capital purchases. What would capital purchases for any company or any organization be? Purchase of land, machinery, equipments. In case of a hospital where I took an example, if assistance is given from the government for that, the dialysis machine, then yes, that's a capital grant for you all, okay. Again, just like revenue grant, we have two sections or two types here for treatment. One is your revenue method, meaning you will treat the grant money as a income in your profit and loss statement, just like how you did it in your first type of grant, that is your revenue grant, okay. So treat the grant as an income. Treat the grant as an income in profit and loss statement. Till the time the condition for deserving the grant is not met, again you will park it in deferred income in the liability account because you don't deserve it yet. You have not done anything towards it to deserve it, okay. So it will be parked in deferred income, which is a liability account. This I already told you last time also. It's a liability account, okay. Now method 2. How is method 2 different? In method 2, instead of treating this as a grant income, you will treat it as a reduction to the cost of asset purchased, okay, to the cost of asset purchase. Treat the grant as a deduction to the asset for which it was given, okay, deduction to the asset for which it was given. Now, how is the treatment here different from method 1? When you treat it as a reduction to the cost of the asset, as a result, what will happen now? A reduced depreciation will go in your profit and loss statement. In your revenue grant, what was happening? What was different? A reduced expense was going to your profit and loss statement for which the revenue grant was coming. Same thing over here, a reduced expense is only going because depreciation is an expense. The original expense must have been higher, but now because of reduced cost, a reduced depreciation will go and sit in your profit and loss statement. People who use these two methods, what do they argue? Organizations which would use method 1 would say that they would want the cost of the assets to be comparable, okay. If you reduce the grant money from the cost of the asset, then the cost of the asset will reduce. So they would want the cost of the assets to be comparable, is why they don't want to spoil the figures. So they will treat the grant money as grant income in the profit and loss statement. People who use method 2, basically organizations who use method 2 will argue that they only made the purchase of the asset because they were encouraged by the government from the grant money. Only because they assume the cost of the asset will be cheaper for them is why they are entering into this expansion project. Otherwise they wouldn't. So why should they record a higher cost of the asset, and then they will choose to reduce the cost of the asset, okay? Now let's see how accounting treatment would look like if we happen to adopt either of these methods. So we have a numerical example. An asset of 200,000 was purchased with a life of 10 years. Grant for the purchase was received up to 50,000. Okay, so an asset of 200,000 was purchased and life was 10 years. Grant for the purchase was received up to 50,000. So let's see, as per method 1, how would we record it? Now in method 1, where we choose to credit as income to profit and loss statement, what we would have done, say if this was a profit and loss statement where we were recording, we would have recorded a grant income basis for how many years we've kept the machine, or basis the depreciation method. Because if you write the cost of the asset based on a particular method, the depreciation method, the writing of the grant in the P&L, meaning the writing of the grant as an income in your P&L, will also happen basis the same method. If it's straight line, if it's WDV, written down value. Okay, here it's straight line and it's 10 years. So grant income also, because if you receive 50,000, then 50,000 by 10, which is 5,000, is what you deserve in the first year. So year 1, you would be in a position to record at least 5,000 of grant income. Okay. Parallel, what would you have at the end of year 1 in your balance sheet? Now, in the asset side, you probably have an asset with a cost of 200,000. Okay, and in the liability side, you have a deferred income. Okay, you have a deferred income of about 50,000 less 5,000, which is 45,000. Also understand that there will be depreciation regarding this asset. So life is 10 years. So I'll have a depreciation amount of about 200,000 by 10 years is going to give me 20,000. So 20,000 worth of depreciation. And this is going to get deducted from the cost of the asset in the balance sheet. So in the balance sheet, in the outer column, what I'll have is a 180,000. So this is as per method 1. Okay. You'll see in method 2 the same kind of grant income you record, which is 5,000. The depreciation being the same again, 20,000 negative item. Asset cost will reduce further by 20,000 and deferred income will reduce further by 5,000. The net impact that we see going in the P&L is a negative 15,000 every year because of this. Okay. Now let's see how we would do this in method 2. In method 2, where we treat it as a deduction to profit and to your balance sheet item, meaning your asset, how would you record it? Okay, so I'm not going to record anything as grant income, but I'll be recording a depreciation only pertaining to this asset. Okay, now in balance sheet, how would this look like? So you have an asset. Originally, only when you record the asset, instead of creating a deferred income, instead of setting up a liability up to amount that you don't deserve, you will not credit a liability, but you will credit the asset only originally up to the amount of money received, which is 50,000. So when you credit the asset 200,000 with 50,000, your original purchase price then becomes a 150,000. Okay, so you're not setting up any liability, but recording the asset at a lower cost of 150,000. Now understand that when you take a depreciation of over the cost of the asset, it's going to be 150,000. So life is 10 years. So what are you going to have as depreciation per year in the P&L? A negative 15,000. Okay. Which again, if you happen to deduct from the cost of your asset, it's going to come up to 135,000. So you can see that the net impact in the P&L is still the same. Here also you have 15,000. In the method 1 also the net impact was in the P&L as same 15,000, just in a split manner. Full depreciation and remaining is income, right?
And in the balance sheet as per method 2, I'm not showing any deferred income setup. It's just a reduced cost of the asset. So I have a reduced cost of 135. In method 1, I had an asset 180 and a liability of 45. If I net the two items, I will still have a 135. Okay. So this is it. This is how you will have your revenue grant and capital grant, and both the methods in revenue and capital are quite similar to a certain extent. So there's very little things that we have to remember. Okay. Now, the third thing that we're going to understand over here is there a reason why we would have to end up repaying the grant money back to the government? Will there ever be a case? Yes, it is possible. That could happen if you breach the terms of the grant. If you breach the terms of the grant, okay, if you're not able to, fulfill the conditions laid down by the government, then you might have to repay the money. So you can see over here that if the conditions for the grant has not been met, this could be required if the conditions for grant has not been met. Conditions not been met, then repayment could be required. Okay, then repayment could be required. But the repayment to the government could be partial also and could be full also. What does this mean? Meaning, if you have received money for keeping workers employed for 5 years, and if you keep them employed for 2 years, after that you fire them off. So you have breached, okay, you have not fulfilled the condition. So what government can say is that up to the extent that you have fulfilled, you deserve the grant money, but for remaining 3 years you don't deserve, so you should return it back. Now, if the conditions of the grant is partial, then this is what it means. Okay, the condition of the grant, contract between you and the government is partial repayment, then this is what it means. But if it is full, then it doesn't matter you keep them employed for 2 years, 4.5 years, 4 years, 11 months. If in between the contract you breach it, government requires full repayment. Okay. So here again we will see what is the kind of entries that we could record. What is the kind of entries that we could record. Okay. Now if it is a full grant, so first let me take if it is a situation A where it's partial. Okay, where it's partial. Now in case of partial, what you will do is, first is the first entry that on day one that you set up, when you receive the money, is a debit bank and credit is the deferred income till you don't deserve it, right? So whatever being the amount. Year end 1, what you do is you would reverse the deferred income to the extent you deserve, and then you do a credit grant income. Right? This is what you have. Now suppose after the end of year 1 you have not been able to fulfill the condition of the government, then what do? So at the end or at the beginning of year 2, when you were not able to fulfill, beginning of year 2, when you fired the workers, and if partial repayment is required, then what you will do, you will debit the grant income account created, because no more there will be a liability of this. Okay, and you're going to credit bank. So up to the remaining amount of grant income that you had as a liability, you will reverse it and repay it to the government. But in full repayment, what will happen is your day 1 journal entry is same. That is debit bank and credit deferred income. Your year end 1 journal entry will also be actually same. Whatever you deserve for the year 1, that will be reversed as liability, and credit is grant income. Whatever you deserve is now going to be recorded in the P&L. This is my PL item. Okay. Same thing. But what will change is beginning of year 2. What will come over here is, you will not just reverse your liability, the remaining liability that was set up, not just that. So I will do that, yes, of course, that is there. But the earlier grant income that you had recorded in the profit and loss statement, if full repayment is required, then you don't deserve it. Okay, then you don't deserve it. So I'll have to create a loss for it. So loss due to non-fulfillment. So that needs to actually be eliminated. The impact of that income should be eliminated. So I'll create a loss in my P&L. loss due to non-fulfillment. Exactly whatever amount I recorded as grant income in the last year, that is going to get debited and credited as your bank. So don't worry, I'll actually do a proper numerical. So whatever I've done over here, you will understand better using a numerical.
Now let's do some question practice on the government grants. They're the quiz questions. I'll start from question number 3. I'll read the requirement and I'll then read the case study. What is the deferred income balance as at 31st December 2015? It's very important to be clear with the requirement of the question. The requirement is the deferred income balance. Okay, the deferred income balance, meaning the liability that is standing in the balance sheet. Okay, the liability that is standing in the balance sheet. Also, which date is very important, because if you don't understand the date or you're not clear about the date, then of course you can have a different answer. So even if you're so good with the concept, it's a waste, because if you're not observant about the dates, about the requirement, you will eventually end up giving the wrong answer. Okay. So anyway, the case is a company receives a government grant of 800,000 on 1st of January 2014 in respect of an asset purchased on the same day for 900,000. Okay. So asset was purchased for 900,000 and the grant money that was received was 800,000. Which date? 1st Jan 2014. The asset is expected to have a useful life of 5 years and is depreciated at 25% on a reducing balance basis. Understand that though life is 5 years, depreciation is at 25% on reducing balance basis. This is how they choose to write off the asset in their books. The grant is recognized as deferred income. Okay, so they're not choosing method 2, meaning reduction of the grant from the cost of asset, but they're going to treat it as a grant income, and parallel they're going to create a deferred income in the balance sheet, right, up to the amount that they don't deserve. So anyway, now what was the requirement? Again, coming back to the requirement, they are asking the deferred income balance, the liability balance as of 31st December 2015. So on day 1, alright, on day 1, my liability balance, that is my deferred income balance, is going to stand at the complete full figure of, one second guys, yeah, it's going to stand at the complete amount of 800,000, okay, on day 1, because you have not done anything to deserve that 800,000 on day 1. You've not kept the asset for even a shorter period of time. Now, year end 1, your year end 1 is going to be 31st December 2014. Okay, so year end 31st December 2014, what is your deferred income balance going to be? See, understand one thing, that when you are going to record the deferred income, in your balance sheet, you will remove the element that you deserve out of it, right? You will remove the element that you deserve out of it, that you will keep putting in your profit and loss as grant income. So your deferred income balance will keep shrinking. Now, the pattern of shrinking of this deferred income balance, the liability in the balance sheet, what is this pattern going to be? It's going to be based on the depreciating pattern of your asset, okay? So, I'll just write it over here for you. Writing off deferred income pattern or basis is going to be same as depreciation basis of asset. Okay, so in this case, your asset is getting depreciated at 25% on reducing balance basis. So same thing, your deferred income will also get written off basis 25% on reducing balance basis. Okay, so now when I'm going to write off 25%, or I'm going to recognize 25% of the income from 800,000 in my profit and loss statement, only 75% of the deferred income will remain. So what I'll do is, instead of taking 800,000 less 25% of 800,000, that's too long for me, right? What I'll do is I'll simply take 75% of 800,000. In the exams, you'll have to have your shortcuts ready to do the calculations, because you don't have a lot of time. You're running against time, right? You're racing against time. So we need to have all the shortcuts ready. So 31st December 2015, then what do we have? What kind of deferred income balance will remain? Again, so from 600,000, I'll have to less 25% of 600,000, okay? From 600,000, I'll have to less 25% of 600,000 because that is what I deserve. That is what I deserve as grant money in the P&L. Now, instead of doing that, what I'll do is I'll take 600,000 into 75%. So, at 31st December 2015, I have 450,000. I have 450,000 remaining as liability in my balance sheet. This was the requirement of the examiner, and this is what is the solution that you have provided to the examiner. Okay. Now, going further, we'll come to question number 5. Again, I'll read the requirement and then the case. Match the amounts to be recognized for depreciation expense for the year ended 31st December 2012 and the provision for the repayment of the grant as of 31st December 2012. So, they're asking us the depreciation amount for the year ended 31st December 2012 and the repayment provision for repayment of the grant. Okay. So, we'll read the question or we'll read the case now. On 1st Jan 2011, MX received a government grant of 100,000 to assist in the purchase of new machinery costing 1 million with a useful life of 5 years. The accounting policy is to offset the grant against the cost of the asset. Okay. Now, if the accounting policy is to offset the grant money against the cost of the asset, then this is method 2, where you will remove this from the original purchase price. Okay. So, now if there was no grant in picture, how would your depreciation look like? Your regular depreciation would have looked like a 1 million figure because that's your historical cost divided by the life, which is 5 years. Okay. So, definitely it would be a 200,000 depreciation per year. Okay. Now, because of the grant, deduction from your cost of asset, we'll see how is the depreciation because of your grant. So, what I'm going to do is from my 1 million, I'm going to remove the grant money. So, I'll have a 900,000 divided by 5. So, I have depreciation due to grant of 180,000. I have depreciation due to grant of 180,000. Okay. So, depreciation expense is standing at 180,000. And my provision for repayment is going to stand at nil. Zero amount. Because as such, I have not breached anything for which I need to set off or I need to create a provision for repayment. Alright. The next question. So, I'll read the requirement and then the case. Record the journal entries if the conditions of the grant required full repayment and second is partial repayment. First of all, when will the question of repayment come? Only if there is a breach of the contract if you are not able to fulfill the terms and conditions. So, if there is a breach then and if full repayment is required as per contract, what are the kind of journal entries? And if there is a breach and if there is partial repayment in the contract written, then what are the kind of journal entries that are required? Okay. So, I'll read the case for you all. Government gave 300,000 as grant money to Delhico for keeping workers employed for 3 years from a remote area. Delhico decided to keep the workers engaged in the factory for 3 years. However, at the beginning of second year, due to shutdown of one of the projects, Delhico did not require the workers anymore. Okay. Now, this is an illustration. I've created this question. This you wouldn't find on Study Hub. So, I'd request that you make a note of this question. So, anyway, idea is that government gave on day 1 300,000. Even the company intended to keep the workers engaged for 3 years because that was the condition. But at the beginning of second year itself only, they were not able to fulfill the conditions or fulfill the promise of the contract and they had to then remove them. So, if full repayment is required as per the contract, what do you do? So, if full repayment is required, so your day 1 journal entry is going to be at least your debit bank because that's simple. whatever is the case, your bank is getting hit by a 300,000. So this is simple to record. Credit what? Credit deferred income, because on day one, by any means, you're not fulfilling anything. Okay. This is your liability standing in the balance sheet because you don't deserve this income yet. You've not done anything to deserve it. Okay. Now, year-end one. Year-end one, what is going to happen? Now, at least for 1 year, you've kept the workers employed. So, at least to that extent, you deserve the grant income. So, credit your grant income up to 100,000. And by that amount, your liability should also reverse. Your deferred income liability that you've set up, it should reverse. You shouldn't have a complete liability of 300,000. So, by 100,000, you will reverse it. Okay. Now, what happened in the beginning of second year? You were no more able to keep the workers engaged in your business. So, you have breached, okay, or you have not been able to fulfill the conditions of the promise. And the government and you, and the contract between you and the government said, if you breach it, full repayment will be required. Alright. So, we make a full repayment, which is credit bank, 300,000. Okay. Now, entire deferred income, which is still remaining as a liability in your books, now it's no more your liability. You have already paid the money to the government. So, reverse that and debit a loss due to non-fulfillment. Why do I say debit a loss due to non-fulfillment? Understand that last year you've already booked certain income. You've already booked certain income. No more you deserve it basis the words of the contract. Okay, so you will have to negate the impact of this income. So you will have to debit something of 100,000 in your P&L, right? So I'm writing debit loss due to non-fulfillment. Okay, so debit 300,000 and credit 300,000 is now matching. Now let's see how would the sum look like if partial repayment was expected, which is the second case, by the way. So guys, nothing would change on your day one because day one it's still bank getting hit by 300,000 and it's still a deferred income of 300,000. You don't deserve it yet. Even at the year end one, nothing changes. Because of course, year end one meaning you've kept them engaged for 1 year, so you deserve that income of 100,000. Record that and reverse your liability by 100,000. Now, beginning of your second year, things will change here. Understand that at least for 1 year we have kept the workers employed, so that much amount of money we deserve. So, by any means, I will not now try to negate the impact of grant income of 100,000 recorded last year. I'll let that stay there. That grant income recorded is perfect because as per the conditions, only partial repayment, only up to the extent I've not fulfilled the contract, I'll do a repayment. So up to what extent I've not fulfilled? For 2 years I have not. So how much of the money I'll have to end up paying to the government back is credit bank a 200,000, right? A 200,000. And because I've already paid the money to the bank, I'll have to also now reverse the liability that I had created. So I'm going to reverse this deferred income by a 200,000. That's it. This easy was government grants for us.